envisaged economic recovery in 2021 is predicated on two fundamental things. One is the rolling out of vaccines, so en masse vaccination, that's critical. And the second is the maintenance of support from central banks and the fiscal authorities. And my expectation is that this support is going to be in place. If central banks learn something about the great financial crisis, is about the risks of prematurely withdrawing the central bank support. So, as I said, I don't think that it is reasonable to assume that interest rates are going to increase soon, or that there is going to be a reduction in the rhythm of asset market purchases, which provide a further accommodation, which is very much needed. So I think central banks know what they have to do. And my expectation would be that both them and the fiscal authorities will continue providing the necessary monetary and fiscal accommodation until the recovery is strongly underway.
So you're far more of a student of banking than I am, but if you have fiscal support, monetary support, and a post-pandemic environment, isn't that quite a dangerous stimulatory mix, so to speak, which can create not only higher inflation than central banks are comfortable with, but also bubbles across the board?
Well, there are always side effects when you administer a medicine in order to keep the patient alive. And central banks are very well aware of the risks to financial stability, which comes from the accumulation of debt, particularly in the private sector. And this is why financial policies are in place and will be used. For example, macroprudential policies. So I don't think that central banks are oblivious to this. But let me tell you one thing. If there is something that would be extraordinarily detrimental to both the economy and to financial stability, and which would lead to a lot of bankruptcies, that would be a prematurely withdrawal of central bank support.
Jose, if we finally have the inflation genie out of the bottle on the back of this pandemic, are we as low as we can go on European yields? Is this it for now?
Well, let me question the assumption. Of course, yes, there is a possibility that there could be higher inflation. And there will be some higher inflation on a temporary basis. But I don't think that this is something that either in Europe or in the United States is going to lead to a significant increase in underlying inflation or core inflation, which is what ultimately matters the most, the longer-term trajectory of inflation. For instance, in December, the European Central Bank was forecasting that inflation by 2023 would still be 1.4% headline inflation. This is certainly well below the 2% that it's their objective. And in the United States, we have seen the Fed moving to average inflation targeting, which basically means that the Fed is likely to consent inflation going above 2% for quite some time in order to compensate coming from below 2%. So certainly, I don't think that's going to change the attitude of central banks, because inflation is not going to be there on a sustained basis. Now, if I were to be wrong and something happens to make inflation go higher, and I think that this is a very, very small probability, then I think that we would be in a difficult situation. But let me just reiterate, I think that this is a very unlikely scenario, non-zero probability, but extraordinarily unlikely.